Hello, and welcome back to the Wall Facer podcast. Today, I'm joined by John Morrow, co-founder and COO of Gauntlet, and Holt Butler, who leads product for Gauntlet USD Alpha. Guys, welcome to the show.
Thanks for having us.
Hey, yeah, thanks for having us. Long time listener, first time caller.
Great to hear. Yeah, I've wanted to have you guys on for a while, so nice to finally be able to do it. Let's kick off with the basics. I will assume that anybody listening to this niche crypto podcast is familiar with Gauntlet. I think even for me, looking back from when I first came across Gauntlet in 2018 to what Gauntlet is now, I definitely think of it as two very different kind of firms. So I would be really curious to get the origin story and what sort of the founding insights of Gauntlet was, and then how it has evolved over time to what it is today.
Yeah, great. Happy to help there. I think it's totally reasonable to say that our business has changed a ton over the 7 years Gauntlet has been around. I think in many ways, though, there are some things that have really been the same the entire time. So we've always been building financial models for crypto. I think when we first started, we were focused on things like, consensus and proof of stake networks and things like that, which are also, economic arguments, right? The safety of proof of stake, liveness, these are economic arguments about the incentives of participants, right? And I think, DeFi was always something that was interesting, but back in 2018, there wasn't a lot going on in DeFi. I think there's like $100 million in Maker. And yeah, it was just not a market where I think we could target yet. And I think over time, we just sort of followed our mission, which was to bring quantitative rigor to crypto to help people understand these things better. I think it's really powerful that one line of solidity can create an entirely new financial product. But with that power comes great responsibility. And I think if people keep losing money, it's going to be hard for the space to grow. So that's always been sort of our vision. Now, we first started working with protocols directly, and I think we sort of made a name for ourselves, managing risk with protocols like Aave, Compound, and others. And over time, we just have seen that as people move away from systems that are governance heavy and things like that, over time, we've just seen that the best way to deliver value is to just connect our models directly to on-chain products. Of course, non-custodially, with all that good, all that good stuff. But yeah, so I think it's really, hey, we've always been building financial models. It's just now with the advent of vaults and the proliferation of them over the past 2 or 3 years, it's given us just a much better opportunity to add value and grow our business in a much more scalable way. So, I think research is always going to be part of who we are. And I think it will continue to be. However, vaults are just the best way for us to deliver value to users with our research and platform.
Yeah, you bring up a couple good points there. And I think, my first memory of Gauntlet was maybe like governance modeling, like, if this decision, sort of what happens, what flows throughout the system. And you're right, today governance is less important at a lot of these protocols. So I think, it's a natural evolution there to some extent.
Yeah, absolutely. I think much of the decision making we're doing on Morpho, for instance. I think Morpho and Aave are an interesting comparison to make. So we worked on Aave for a very long time. I was personally sad to leave it when we did, but we felt vaults were coming, and that was a better opportunity for us. And but one thing is, like on Aave, we're running all these models and we're trying to optimize parameters, and many of those parameters actually exist in Morpho. However, these parameters are not changed through governance. Anyone is able to create markets in Morpho, which is very much not the case on Aave. And so, some of the parameters are the same, right? Like something like max LTV on a loan, right? Hey, given that you've put CBBTC, which is collateral on both Aave and Morpho, you post that collateral, how much can we lend against that safely? Some of these are some of the same questions. Now, on the optimization side of things, so I think on the risk side, some of the questions are quite similar. On the optimization side, before on Aave, money is just lent out across their markets. Now they have isolated markets and things. However, on Morpho, we get to decide where money is lent. So we can constantly optimize basically across different assets how to distribute vault deposits. And so that just allows us to deliver much more value to users, right? Because we're making optimizations many times a day. And if markets are volatile, many times an hour. And that's just something you're not able to do in governance-based systems. I think it's something that's better for users and in many ways better for us as well.
Yeah, definitely just the reactiveness and speed that you can do things in a Morpho and Euler. And anyone that adopts that type of model is much quicker. Also, I remember, and I think I've talked about this on the podcast before, just in the context of kind of curation. I remember a while ago looking at Compound, which, at the time, Compound's maybe being a bit revitalized now, but also thanks to some of the things I guess you've done with Compound Blue. But I remember sort of looking at it and having the thought of like, once the core team had kind of stepped away, I think Gauntlet really stepped up to take on a lot of the responsibility at Compound. And I remember thinking to myself, well, if Gauntlet's doing all this work for Compound to get paid, $1 million, $2 million a year, whatever, why don't they just take the learnings and launch their own lending protocol? And I think to some extent, maybe that's where Aera comes into the picture, but certainly I think Morpho and these other places have allowed firms that otherwise might have gone down that route to become strategists on this open architecture that they can now work on and basically build their own lending type of businesses.
Yeah, I think for us, the question of something like building our own protocol, it just comes down to like, what do users want that we can't do? And I think, we do have a protocol that we incubated called Aera that allows just basically more complex portfolio optimization strategies on chain, and it's just things that weren't offered by the other basically vault systems that we saw. I think if there was a world where Morpho would have never come along or something like that, then maybe we would have had to launch our own protocol or something like that. But for the most part, like we're building tools that help anyone allocate funds better on chain. By positioning ourselves in a way we're able to help lots of people, we're just going to drive more value with those tools. So there's a trade-off there, which is, of course, hey, maybe we just want to own everything and fully vertically integrate. And just for every product, we have a Gauntlet version of it that competes. There's probably a balance that we have to find there where, you don't want to boil the ocean and you also want to create great user experiences. And so there's just a bunch of trade-offs we make. And I think, that's kind of how we landed.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
Yeah, well, definitely we could spend a bunch of time on Aera. I guess before that, just as we're kind of talking about the curation role generally, and Holt, maybe we can get you in here too, is there's this debate I keep seeing come up on X and, in different group chats and stuff around really what is the curator, right? Is the curator someone who is some sort of a risk manager? Are they more of an asset allocator, or maybe words that you'd more find in kind of a TradFi context? Like, how do you think of both that role generally, and then maybe specifically the way that Gauntlet sees itself in that role?
I'll take the general take here. Holt, maybe you can kind of comment from our perspective as well. I feel like I'm sort of monopolizing the mic here, but anyway, I think generally what curators are doing is they're providing data on chain, right? So all of these vaults, or all the vault systems we work on, are non-custodial, and so these are just smart contracts published on chain that anyone can use. Now, you can go to a website that helps you deploy, them quickly, or a website allows you to basically share those smart contracts with other participants, things like multi-depositor vaults. And so, I think in many ways we look almost like a chain link that's providing, instead of just really robust price data, we're providing really rigorous, basically risk and other allocation data on chain that allows these vaults to pursue kind of complex investment strategies over time. And I guess in the end, vaults themselves aren't doing things. It's the users that use those vaults. But it's very much the promise of DeFi, right? Instead of having to pay some intermediary, a bulge bracket bank or whoever it is, or an asset manager to invest some money for me, I can do it myself. And the data feeds that we provide, though, looking quite a bit different than something like the Chainlink, but that allows people to pursue complex investment strategies. So that's kind of how I view curation. I think one thing about the word curation, it doesn't sound like you're doing anything, right? Like curators aren't like creating. I think that's like a huge differentiation. Is around like in the art world or something where people use the word curation a lot. I think that's a little bit of just literary legerdemain, and that like people want to sound like they're not doing anything. I'll tell you, being a creator is a ton of work, but yeah, I think what we're doing is, yeah, it's very different than asset management. It's very different than what someone like a Chainlink does. Though I think that's probably the closest comparison. It's just that, hey, we're doing a lot more than medianizing when we're publishing data on chain. It's years and years of R&D into it.
Yeah, and really quickly, I'll just add to kind of how I see the market and things playing out. It's just really interesting how, these protocols have popped up that have, like Morpho, that have enabled this new space. And, I think people like Gauntlet and Steakhouse and other curators out there are trying to make a name for themselves right now, where we become basically a brand of like, hey, we're an on-chain team that you can trust basically to like take care of your funds and make sure that things are as safe as possible. And so I think it really will be a sort of a game to prove how smart you are and how well you could take care of those funds. In long term, I do think you could see some of these curators blowing up and people, maybe not taking as much care as they should, and markets not working out how they expect. Obviously, when everything's up, like things are going pretty well, but I think it'll be really interesting to see how like durable some like the whole curator market is, and how different ones end up, becoming really powerful like long-term players, and just watching some fade to the side. So yeah, it's really interesting. It's an early space, so it's very much like a game theory right now.
Yeah, I agree with that. Hopefully we are quite a long way from any sort of major blowups. But, I guess something else with this model too is that I find interesting is like, if you think of the history of this in crypto almost, you could maybe say something like Avant-Garde, which I forget the previous name of it, was like maybe a first pass at something like this, where you could have these on-chain strategies, but they were much more hedge fund-like, I think. Like they was focused on like kind of token buying and strategies like that. You could think of something as like Maple's pool delegate model and like what all of the uncollateralized credit protocols did. And now this is like I would say, very DeFi native, like the way that it actually takes the most advantage of the on-chain rails to allocate capital across all of these different strategies. So yeah, it's interesting just that it feels like every day protocols are now adopting this curation model over the previous sort of governance-led models for allocating risk.
Yeah, I think like, I'm as big of a blockchain crypto fan as anybody, but I'd say like decentralization, all valuable, does come with some costs. And I think that you look at a system like Bitcoin, and it's really not the fact that you have this distributed database that makes Bitcoin valuable. It's the fact that it actually, in creating this database, you prevent double spends, right? And that's what's actually really protecting the value. It's really the constraints of Bitcoin that added to its value. It's not a distributed database. They've had those for decades. And so I kind of see like the role of on Turing complete blockchain systems. If you extend that metaphor, you don't ever really need to do complex computation on chain, and having everyone running Ethereum nodes everywhere trying to do complex computation for you is very inefficient. And so I think for us, we look at the on-chain smart contracts and just the systems in which we curate as creating the right constraints to meet user expectation, the same way that double spending Bitcoin did. So I think the more you try to push stuff on chain, you have this thing where there's incredibly diminishing returns to doing more and more complex calculations in a distributed ledger. This is actually, I think, one of the things that prevented Yearn from growing. I think the Yearn team, it was the most interesting product in my eyes in DeFi summer in 2020. However, and they had a model where anyone could actually add new strategies to Yearn. However, it had to be almost entirely via smart contracts. Now, some of them did rely on oracles and stuff, and you can always jam information into Oracle to get around sort of the constraints in their system. But they tried to put basically too much stuff on chain, and it did two things. One, it didn't allow them to innovate quickly, and two, it made all of their risk a smart contract risk, which is of course going to cause issues in the long term, and of course they had lots of strategies that didn't perform as expected and things like that. So hey, I think we've always been betting on off-chain models. First we were entirely off-chain, and now we have sort of this blended approach. I think you see things like Base recently announced that they got 10 times faster or something like that. Solana's fast, Ethereum's scaling across all these different L2s. At some point, maybe we will be doing very complex calculations on chain, but I think that time is pretty far in the future. In the meantime, we're going to make everyone as much money as possible. And that's going to be a combination of on-chain logic that provides the right restrictions and the right guarantees to your capital, and off-chain logic that maximizes your returns.
Interesting. Yeah, the blend of on and off chain. And I think we actually see other vault products now that I would say are taking even more off chain approaches, where like it's almost just taking off chain, even like an options strategy, and just sort of like tokenizing the returns of that. I mean, I've seen a few of these now where it's a little bit even more like a tokenized off chain hedge fund, and they're just sort of passing the yield along, which you could argue is maybe like an Athena type of thing where most of the activity happens on a centralized exchange, at least historically. But yeah, I think we're going to see more and more experimentation in the less decentralized direction, for better or for worse. Well, I would love to dive a bit into what you talked about actually in the process that goes into curating all of these vaults. When you guys are thinking of launching a new vault or pool or strategy on Morpho or any of the places where you curate today, what goes into that? What goes into the asset selection? How much of the work is, risk modeling? What's the day-to-day like? Like how much of this is manual, automated? I'd love to just learn the behind the scenes without sharing anything too confidential.
Hey, I'll do my best to share as much as possible, though it is a little bit of a tightrope walk just to say something that says literally anything and also not spill the secret sauce here. So yeah, so apologies in advance for my vague platitudes. But yeah, I think our perspective here is we want to automate as much as possible. I think we do a ton of manual checks and things like that, but having a human in the loop is a great way to catch corner cases. And, there's just a lot of different things with basically who controls assets, how they're issued. And, you can automate things like ensuring you have the right like decimals number, right? Because decimals different on every ERC20. And, there's a couple weird ones like USDC where there's like these kind of predictable gotchas. But having someone check these things is kind of how we've lasted 7 years in crypto and in DeFi. So yeah, I think we're automation first. We have an insane amount of monitoring. From memory, I don't think I can list half of the different monitoring systems that we built and licensed. So I think it's having a ton of automation and then having an efficient system for leveraging humans in the loop that are going to prevent the worst sort of downside cases. And then occasionally also uncover new upside. Like a lot of our companies, the manual stuff we're doing is researching new strategies, right? And researching new markets. Oh, hey, this trade looks really juicy. Well, what's the capacity? And, if the capacity is really low, then it's lower priority. If the capacity is really high, it's something we'll move mountains to sort of bring on chain for users. So yeah, I think you want to be as automated as possible, but there's some really high value things you can do, like preventing total loss scenarios, as well as identifying new strategies that you want a data scientist just to look at. Of course, AI-enabled data scientists, everyone at the company is using AI tools to write code and things like that, so we can generate as much of the stuff as possible. But, in the end, we want a human being to be responsible for all of this stuff. So
yeah, it makes total sense. And I guess even just in that, something you said earlier too, sort of the mission is like to make people as much money through these different strategies as possible. That yes, it's like, I don't know, maybe just thinking about this evolution of Gauntlet. In the past, it was sort of managing risk. And while that obviously still is a huge part today, it's a little bit more on the alpha generation side and finding these places that you're going to move mountains for and, figure out how to allocate capital to. Is that a fair sort of description?
yeah, I think part of risk management and effective risk management is understanding growth opportunities and making trade-offs, right? If you're not thinking about growth as a risk manager and you're just sort of like the department of no, like that's actually not adding a lot of value, because that's actually the best way not to lose anybody's money is just to go out of business before anyone gives you their money to begin with. Right? So if you're just worried about risk, it's just like not valuable. We've always cared about those trade-offs, though now we're able to optimize around them much more directly than we had before. So I think that's sort of the change there.
Well, that's kind of a perfect segue into what is now Gauntlet USD Alpha, gtUSDa. I'd love to get the backstory of Aera itself as this protocol that you've incubated, and then also what the mission and idea is with gtUSDa.
I guess I'll give a quick Aera backstory, and then Holt, you can jump in with all the details on the Alpha Vault, because this is sort of Holt's baby here. So, I think in the end, as I mentioned earlier, it's just we saw an opportunity to better leverage our models on chain. I think the first use case for Aera we wanted to do was actually a vault to manage and insurance funds on chain, because that was really close to what we were doing. We saw these big piles of money. We saw this thing where we were like, hey, it's really weird that like Aave has this big insurance fund where all of the money is in Aave, which is the asset that is most likely to depreciate in the case that there's ever an issue on Aave and they do need to pay out. So you have this weird thing where like all the insurance funds being held, or in Aave is just you stake the Aave token. Right? All of these things are denominated in the worst possible asset with which to preserve value long term. And so we were like, okay, maybe we vault up, or we allocate these things over time. And that's sort of how we started looking at this. And then we're like, oh wow, this actually is sort of something that could be used across a ton of use cases. So then we started building a protocol around this, and yeah, over time, just saw more and more opportunity to move on from just that one use case to others and other high growth opportunities. And one of those was the Alpha Vault. So I'll let Holt take them.
Yeah, for sure. And like a little bit more background on Aera and where it's at. So previously we were in Aera V2, and V2 was very much on-chain focused. We built a lot of the infrastructure as on-chain, including the oracles, and all of the pricing was done on-chain. So it's this very different way of thinking about how we manage the vaults, and just like high level of trustlessness in that, right? Which I think like when we built Aera V2 was sort of the ethos in DeFi, like we were trying to be as trustless as possible. And so the Aera V3, actually, so probably ran into a V2 is like same thing that we mentioned with Urine, where you actually can't innovate as fast as you want when everything is done on chain. There's a lot of just signing transactions and getting things updated, and just things move very slowly, right? So V3 was essentially let's go and tackle the same use case where like people have these funds on chain. They want them to be added to strategies or different use cases where they need to, let's say, TWAP out or get yield or trade. And maybe they don't want to do that themselves. Like, how can we enable that sort of use case where Gauntlet's able to manage a strategy for someone without taking custody of those funds, and also while iterating on that strategy and being able to add new assets, new protocols, whatever we need to do much more quickly. And so V3 basically has a balance of on-chain and off-chain trust models where it allows us to iterate much more quickly, allows us to change the strategy more quickly. And so that's sort of the core infrastructure that's running the Gauntlet Alpha Vault. And so the Gauntlet Alpha Vault was really, us just seeing a ton of demand for USD yield in general. There's a lot of hype around the Circle IPO. Stablecoins are super hot right now. So we looked at different things like Ethereum, Bitcoin yield, and kind of landed on stablecoins are like the hottest thing in crypto. And honestly, in my opinion, probably going to be crypto's killer use case. I've spent a lot of time in Latin America actually, and you just kind of see how much it's used down there and how much people actually know about like things like USDT, and they use the Tron network in Binance. And so there's like real world use cases where this is happening. And I think the US is kind of opening up in a way where it's going to make a lot more sense for it to happen here. And there's a lot of regulations coming down that's reflecting that as well. So for us, just like the whole stablecoin market is just a huge opportunity. And one of the most difficult things is chasing yield. Like we are all at Gauntlet DeFi users. We all understand the problem of trying to go to different lending protocols. Yields are changing. Like you're trying to loop, then you have to like unwind a position. Like there's just so much you need to do to maintain and get the best yield possible. And so when we're talking about like, hey, what kind of strategy do we want to launch as our MVP? USD Alpha was pretty much the most logical thing because all of us have USD. We're all on chain. We all see like the pain of DeFi. And we talk to institutions all the time. We're talking to hedge funds and large asset managers that are asking for things like this. So we saw a gap in the market, and that's specifically why we went after the USD Alpha product. And I'm happy to go into the strategy and what we're doing there. But yeah, just want to stop there for a sec.
Yeah, please. I'd love to get into the strategy.
Yeah, for sure. I think one of the coolest things about V3 is we're actually able to run strategies cross-chain, which I think is unique in the market right now. And a lot of other vault providers are not cross-chain yet. Basically our MVP strategy was very simply a Morpho optimizer across mainnet and base using USDC denominated assets, and then we actually spread out into things like eUSD and Syrup USD as far as different assets we're willing to go into. So what we're doing with this is like obviously we go live with Morpho, but there's so many other protocols we can actually go after, and so this is sort of alpha, and probably by the time this podcast comes out, this will be in public, but we're going after Pendle PTs as the next yield source that we're going for. That's going to add around 2% APY to our current about 11.5% APY. So you can see that APY jumping up to about 13.5%. And that's on stable coins, and that is not even starting to use leverage on PTs. And so like next thing we want to go after is actually levering up these PTs and getting that additional yield we can get on top of Morpho markets and other markets where we can get leverage on PTs. And that should add another like 2% APY as well. So realistically, we'll continue to go down this path of going after the top protocols. So we're looking at things like Euler and other protocols that offer, lending markets that are really strong. Basically, like our criteria of selecting new assets is how much capacity can we get? How much APY does that add to our strategy? And does it fit within our risk model? And so like, obviously, like with all of this, we're using Gauntlet's deep understanding of DeFi and our risk models to basically say like, okay, what markets do we feel comfortable in? What do we not feel comfortable in? How much leverage are we willing to go after? and what assets are we willing to use, right? Like there's a lot of stable coins right now. Like, I mean, if you were here last cycle, like, things blew up and it was like not cool. And I hope we don't run into that again. But when you're thinking about a stable coin strategy, there's a lot of really juicy yields out there that it may be fine for a little bit, but at what point does that become unsustainable? At what point, like, are you concerned about the collateralization of the underlying assets? Like there's just a lot of concerns that we have. And our number one goal is to provide the best risk adjusted yield. And so how we do that is by understanding the underlying assets and like the depeg risk. Like we do not want our customers to have any sort of drawdown if they're giving us USDC and looking for USD denominated products. That's the strategy right now. Again, is mainnet and base. We're looking to expand to as many chains as possible on EVM that can give us that next level of yield. So obviously there has to be a lot of liquidity, and then just going after all the protocols that'll help us get that like highest risk adjusted yield as possible.
Yeah, you bring up a bunch of kind of jumping off points there. I guess one question I've had sort of just recently, having spoken with a few kind of like family office types, small yield funds, folks like that. Something I've heard from a few of them is that when it comes to where they're trying to allocate capital, a lot of times they will circumvent the vaults and just lend to different markets directly, right? Effectively, like sort of watching the strategies that other people are doing and sort of copying those strategies because they can go direct on some of these things. With that, I guess, how do you envision sort of where gtUSDa sits in this stack? Like, do you think it is something that you're going to institutions, they're going to see it, they're going to want it, they're going to be accepting of whatever sort of fees are maybe involved in that, or are they just be like, let's just try and copy the strategy directly? How do you envision the user? Yeah.
I have some thoughts there, and Jema, feel free to jump in if you have additional, because I know you've had a lot of these conversations as well. But the way that I see this playing out is, and we've already seen this playing out in practice with the vault, is we are a place to park idle capital at a high APY. If you see a strategy where you're like, I'm going to go get alpha that like maybe Gauntlet at its scale can't get, but I can get, then I think those capital allocators should go after that, right? That would be like someone who's really in tune with DeFi, and like we have levered PTs as a part of our strategy, but they're like, hey, Gauntlet's getting 15% APY, I can go get 25 direct and I'm okay taking this trade. Then I think those types of allocators should go after that trade directly. I don't think that we need to sit in between and they can, potentially get less yield being there. But where it makes a lot of sense is when they're like, okay, that trade has now been traded out and there's actually not any alpha going after that, and Gauntlets is the next best thing, and the capital ends up coming back to us. And we've already seen this in practice where people are, taking directional trades, whether it's on Hyperliquid or direct to going to Bybit or Binance. So people are withdrawing and depositing to exchanges, and the capital ends up coming back. So it's kind of interesting where I see us as like a place to park capital that's like, as far as yield, is really high and you don't have to think about it. But if you do have an idea of where to go get outsized gains, you should take that trade any day. So James, I don't know if you have any other ideas around that.
Yeah, I think like when we say family offices, there's two, I would say, totally different species. There's, crypto founder family office, and I think they're probably more in a position to do something like copy our strategies. And then there's also like do the fully institutional family office, multi-generational old money kind of style investors. And so that latter group, they are very far from copying anyone's strategies. I think the people that are more aggressive about it, hey, I'd love to see you try. I think one thing is you will see how closely you're tracking our upside. If anything goes wrong in your systems, you will very quickly learn how poorly you're tracking the downside protection that we have. So it's one of those things that's like, especially in these yield strategies, right? They were like the crypto corollary of a money market fund, right? And, you're going to see your yield go up 364 days a year. But when you are copying our strategies and you don't have risk models, you don't have risk off infrastructure, you don't have all this alerting, monitoring, people doing market research, well ahead of the trends that might blow up your trade. Last day of the year, when there's an anomalous market condition and there's a real risk that you need to move off of immediately, you're going to be at a massive technological disadvantage as well as just like a market disadvantage. You're going to find out because you're going to see us leave risky markets before you, and then you'll be scrambling to get your money out. So, I don't know. I think there's a lot of value to it. People always ask, like, hey, how do you guys have like real IP if all of your trades are public? And I'm like, well, in HFT, things aren't that private to begin with. You can see other market participants. There's an open order book. I think the things are more transparent in DeFi, and that creates advantages. And those advantages easily offset the disadvantages in something like IP protection, which is only something that people who ship slow care about anyways. If you're shipping faster, that's actually its own IP. Anyway, I'm kidding a little bit, but not really.
No, it makes total sense. Okay, well said. So coming back to Aera a little bit too, I mean, obviously gtUSDa is the flagship product today. I think maybe what I'm kind of hearing though is that within Aera, it's possible to have many of these, right? We should maybe expect a gtETH, GT right? Like all sorts of different strategies that can exist in here. Is that the vision kind of where this is going?
Yeah, there's sort of three areas where we could expand with Era, and I'll just talk about the way we're thinking about it, and nothing set in stone. But yeah, one of the key ways obviously is start building vaults for strategies on top of assets that everyone knows and loves. ETH and BTC are obvious ones. Maybe there's some other assets that are large enough for us to go after. Like one I could think of offhand might be XRP. Like how many XRP yield vaults do you know about? Like, it's an interesting token, a lot of people, a lot of volume. And so maybe people want to get yield on top of that, and we might be in a good position to do that. So the other place that I could see us expanding internally, like in sort of the same area, is actually different risk profiles on the same asset. So you can imagine, like we think about, in Morpho, we have our prime, core, and frontier. And just to give you a sense of where we're thinking about this alpha vault, it's currently like between core and frontier, probably leaning towards frontier yield. So this will probably always be our sort of like risk on sort of yield vault. But I could see a world where larger institutions are coming in and saying, hey, there's a part of your strategy we don't like, we like everything else. And so we may need to develop strategies that are more in that core prime area. And so that's definitely something we're thinking about, but focus right now is for sure just the Gauntlet Alpha, and we'll expand down the road when we see more demand for that sort of vault. So two other places we can definitely see expanding. So first one I'll talk about is just partner vaults. So you guys, I'm not sure if you're familiar, but we have this vault that we're running with Securitize and Apollo on Aera V2, where we basically take their ACRED and loop that for additional yield. And so, we see a lot of opportunity in the market with running strategies for people that are maybe not quite as native on chain, that really want to, maybe they have their own off-chain asset they want to bring on chain. Maybe they have their own strategy that they want to build, and they're just not the type of, like, they're not DeFi focused, and they have ideas, but maybe just not the infrastructure to do it. I think we're in a really good place to support those people, to actually help them build out the strategies that they need. And so I think that'll be like down the road, another place we'll see ourselves scaling and expanding, is especially with RWAs, I think are really interesting these days. And yeah, any similar assets. And sort of the third place that I see us scaling, and this has always been the dream for Aera, and it's definitely further down the road, but is actually having external vault strategist running on top of Aera as well. And so in this world, Aera is a permissionless protocol. Someone can come in and actually deploy their own vault and use our infrastructure as a way to run their strategies. And we see our vault infrastructure as best in market. And, I really do think as we expand and add assets and add different protocols, like all of that is actually available to any vault strategist. And so as we start to add this for ourselves, we're just expanding the universe of available strategies for other people to build on. And there's a lot of work we need to do there to, be able to onboard people and have a SDK and like a strategy set that people can then go and work and build their own strategies on top of. But we don't just want to build our own strategies. We want to enable anyone to come in and also be able to build their own strategies. So down the road, we definitely want to scale into some of those different areas.
Yeah, one thing that also kind of comes to mind here, let me just ramble for a second with this question. But I guess in the world where something like Aera takes off, and that sort of maybe becomes the way that billions of dollars kind of get allocated through these different protocols, like something I've been thinking a lot about, even with just sort of, the Morphos and Oilers of the world, and then the Curators, and now kind of Aera as well, maybe sitting on top of that to some extent, is who kind of owns the customer relationship in some of these scenarios, right? Is it Gauntlet that owns the customer relationship with someone that integrates their Morpho pools? Is it Morpho that owns that relationship? In this case, is it Aera that owns all of these relationships, and it's just allocating capital to where it sees best, and everything else is just sort of two layers of backend, to maybe like an end wallet or something? And I'm curious how you think about that evolution of it.
Yeah, it's a really good question. Another one I have ideas on, and JMO, feel free to bring yours in. But the way we're thinking about it for Gauntlet Alpha is Aera is the vault infrastructure, and that's not something that's necessarily relevant for consumers. Gauntlet is the brand of the vault. Gauntlet is sort of the person you're going to go to understand the strategy and learn about the strategy and deposit to the strategy. BD people that are representing Gauntlet talking about this vault. So the way that I see vault infrastructure going longer term is actually like if you're building a strategy on top of any vault provider, the strategist to me is the person that owns the customer. Because I do think vault infrastructure could become commoditized, and so I don't think people care as much to know where their vault is coming from. They care more about the strategy. Longer term, my guess is it goes towards the strategists. They're the ones that are most incentivized to find the customers. They're the ones that can monetize the strategy the best, and I think they're the ones that are sort of on the hook if something goes wrong, more so than the vault infrastructure providers. So I don't know, JMO, if you have different thoughts about that, but that's where I see it going.
I think it sort of could go either way. So I think, for instance, Morpho is probably a little bit different where, while I think everyone's excited to see our name on Morpho, like there is definitely people on Morpho that are allocating from curator to curator, right? And their relationship is with Morpho. Now, there are also people, so for instance, like have money in Morpho right now, in vaults and stuff like that. I'm pretty loyal to Gauntlet for reasons you can imagine. And so my relationship with Gauntlet, because that actually is the reason why I'm using Morpho and not another protocol. I think you'll see, especially as Holt mentions, like some of these platforms will get commoditized. I think certainly some won't. And also just like bigger players come into the space, then you're going to see that those relationships change. So for instance, I don't know, let's say if Fidelity loves crypto, they talk about crypto all the time. What if Fidelity came and they started curating on Morpho and they brought a ton of users with them? If they left Morpho, people would be like, okay, yeah, but Fidelity is my guy. That's why I'm here. I think that it just comes down to sort of, it's certainly things like brand loyalty and also competitive differentiation. So when Fidelity leaves, the yields get worse, or in the scenario where Fidelity is on Morpho, right? And the yields get worse, they're not going to be able to bring very many people with them. So I think it's kind of a blend there, but I certainly can see that there's opportunities where the curators are going to own the relationship, and there's certainly things now where the platforms do. And I think for the most part, someone like Morpho, they pretty much own those user relationships.
Yeah, I think Morpho's maybe unique in that case, in that I think they understood this dynamic really well, and you can see that they do own a lot of those sort of end relationships in the way that I think no other platform kind of does today. And then that trickles back, I think, to the curators there as well, right? It's a positive flywheel, or whatever kind of MBA term fits best in that case.
Yeah.
All right, cool. Well, something else you mentioned in your kind of earlier talking about Aera, Holt, was around kind of where RWAs are fitting into the strategy, or off-chain assets, or whatever word we're using for them today. Yeah, how do you guys see yourselves integrating more with off-chain assets that are coming on chain, or just riff on that a little bit?
Yeah, Jamie, I'd love to get your thoughts on this one.
Sure. So I think off-chain assets provide a wonderful opportunity to bring basically new types of upside to crypto, and also basically just like real world productive flows of capital, right? So I think a lot of crypto and a lot of the payments made, DeFi protocols are just really all downstream of something like people wanting to go long or get leverage, right? One of the big, I think, innovations of the past 2 years is the HERP LP pools, whether it's GLP, JLP, or HLP. This is a really popular product. We talk to people outside of crypto who hear about the yields on these things, and they're like, how do I get in? Like, how do I put $500 million in this thing? And I'm like, well, if you put $500 million in it, the yields will get a lot worse, because they're entirely derived from trading fees that are shared with these LPs for basically improving liquidity on the protocols. And then you basically have this thing, which is most of the yields in crypto and GLP, HLP, those are prime examples of this. Most of the yields of crypto are entirely dependent on speculation in crypto, asset prices within crypto. And those are actually pretty much correlated with overall, positive trends in the economy. When equities are up, crypto is up. And when equities are up, crypto yield is up, which is actually totally inverse to real world yields. And so you have this thing right now, is there's this massive spread between yields in the real world and in crypto, and they're really not just uncorrelated, they're anti-correlated. And so I think real world assets basically provide a bunch of new yield on chain that fits really nicely with the existing yield opportunities on chain, and just makes all of DeFi more robust and a better basically place to park your money, right? For most of 2024, DeFi yields were like below treasury yields, or it was like over 200 days of 2024. You could lever into treasuries with DeFi margin loans. So that's kind of crazy. Levering into treasuries, that's not something people talk about in traditional finance a ton because it doesn't make any sense. And in crypto, it only does just because no one's closed these spreads yet. And I think certainly people like us who are trying to bring these real world assets on chain, we're trying to close these spreads. I would hate to see someone else do it first, but someone is going to, and we're certainly going to try.
Interesting. Okay. Makes a ton of sense. So yeah, and I agree. I mean, like just to kind of sum up that point too about the almost inverse relationship of traditional yields and sort of crypto yields, I mean, crypto yields are almost entirely margin driven. I mean, would you kind of agree with that statement, right? It's people levering up, whereas in the traditional economy, right, it's this centrally planned, we're going to set a rate based on all of these other factors. And yeah, they just sort of naturally have this sort of inverse relationship to them.
Yeah, and I think a part of it has to do too with the fact that token incentives are so popular in DeFi, right? And so when token prices go up, incentives, which many times are a decent part of the yield, are going to drive yields up. So that's, I think, what's created a lot of the direct correlation. But yeah, I think in the end, just in traditional markets, it's just shaken out over the past few years the past few centuries, that interest rates are inversely correlated to asset prices, which is kind of funny because if interest rates are sort of like the price of time, when asset prices are going up, like people's time are more valuable, right? The asset prices are like derived downstream of some sort of productivity. Right. So there is this weird thing. Technically, they should be correlated everywhere. It was you have a very naive Econ 101 view. But yeah, that's not how we've seen things shake out in traditional markets for a very long time.
Well, something else you mentioned there, just kind of between these more traditional audiences, crypto native audiences, and even talking about things like HLP and these market making lending products is like, how much do you find of what your job is today when you're talking to these firms is still educating them on what's even happening in crypto versus a lot of the people you're talking to now at least have a pretty good basic understanding framework, and maybe you're spending more time talking about what you're doing specifically and not having to do the whole market education. Where do you find that we are in that level of adoption?
Well, I mean, these conversations around what's going on in the market, these are harbingers of real interest, right? Or they're signals of real interest down the line. So, I think we had conversations, or we've been talking to every major financial institution that's interested in crypto for the past 5 years. And recently, some of those conversations have led to real partnerships and product integrations and stuff like that. And I think the one that Holt mentioned earlier is this partnership we have with Apollo and Securitize. And I think it's really great that this year, when we were talking to Apollo, it was, how do we launch as quickly as possible? Which is characteristically totally different than every other conversation we've had with every other financial institution before, I don't know, about 6 to 12 months ago. So, yeah, I think, hey, like when people talked about crypto 5 years ago, people said, oh, wow, this is a great innovation. When people talk about it today, they call it inevitable. And I think everyone's just trying to figure out how they can leverage this technology to provide better financial products for their users. And if they ever want to talk about that stuff, I'm always down to chat.
Well, when you're talking to someone like an Apollo today, and maybe, even just their specific product they have, like, what are the things that they feel are the biggest lifts to their business, their operational, challenges, whatever that is? And I guess, where are the places that are still the biggest hurdles or concerns for them?
Yeah, well, I think that being able to leverage crypto markets. One, I think leveraging uncorrelated interest rates is helpful, right? Because if you're someone like Apollo who has a lot of private credit, this is when crypto interest rates are low, you're gonna have a really good opportunity to do something like lever, which is what our Vault with Apollo does. It basically just levers into their private credit fund. And so I think besides just a different interest rate environment, it's infrastructure that allows them to build lots of new products quickly and, do things like create basically new structured products that would be very hard to offer otherwise, and also automate it and leverage, automation systems like what we have to manage risk, right? So I think, they look at it like, hey, wow, I'm not even able to one, lower costs potentially, but also go down the long tail of sort of structured product ideas that, we always wanted to build, but couldn't prioritize. And we'll actually start building some of them because the costs are lower. Now, I don't want to speak too much for Apollo. I'm just sort of trying to generalize around sort of institutions like that. But I think it's, in the short term, interest rates and being able to lever and stuff like that, that's a big part of the decision, is just the rate environment. And then, but long term though, it's just the technology everyone wants to bet on.
Yeah, I just, again, kind of riffing on this question, but I guess, what do you see with some of the new potential risks, right? Like, let's just say Apollo is, very good, safe as it can get. But then there's the 30th firm that wants to bring their private credit on chain and tries to lever against that. And, where do you see maybe sort of new risk vectors that are bubbling up in some of this that people should just think about and be aware of?
Yeah, I think private credit's an interesting, I guess, first use case for a lot of these RWAs. It's, I think, one of the more popular RWA products right now. Certainly, everyone trying to basically take this private credit and expand the group of people that can access it. Great, in many ways, it's democratizing finance. However, I think for many people who've been in finance for a long time, it reminds them of the junk bond era or something like that, right? Because junk bonds are just corporate debt. It's high interest rate. It's risky. So I think there's this thing which is in the junk bond era. I don't think people were totally aligned with the risks they were taking. I don't think they understood how much riskier a bond yielding 12% was than a bond yielding 8%. Right. And so I think right now, the biggest challenge is to make sure that, hey, as you democratize these products, that you're able to set expectations with users on the risks they're taking. I think that's sort of one of the big things that we'll have to figure out there. Because I think it's great to have access to new investment opportunities. But I don't know, if you're writing angel checks or levering into private credit, you got to realize that, not a lot of people, not a lot of 85-year-olds should be doing those strategies, right? So I don't know, there's a person for every strategy. And I just want to make sure that we're able to provide access to the people these strategies are appropriate for, or the people that really want them in the sense that they know what they are and they do still want to take these risks.
Yes. Yeah, that's just something I'm kind of thinking of because, private credit kind of as a market right now, I think has its own challenges as well. And I do think there would be a great irony if, it's off-chain assets that, take down this crypto cycle or something.
That's how you really made it.
Yeah,
right.
Exactly.
When you are worried about traditional markets, right? Or not just sort of this isolated, sideshow.
Totally. All right. Well, let's come back to the more kind of pure crypto markets for a second. So something that I think you guys sit at the center of, and I'm very curious for your perspective on, are kind of the competitive dynamics of DeFi, maybe specifically sort of within lending markets today. I feel like 2 years ago, whenever someone was talking about crypto, it's, the default 3 or 4 things you say are like Uniswap, Lido, Compound, Aave. Today, it's probably still Uniswap, probably still Lido, but now you say Morpho maybe instead of Compound. And I'm just curious how you kind of see things evolving within the market. Any way you cut it, right? On some metrics, it looks like Morpho's doing really well relative to something like an Aave. Euler obviously has this incredible comeback that everybody's talking about. Aave is still massively dominant in actual market share of total borrow. So how do you see things continuing to evolve, and what else are you finding most exciting in lending markets?
I think it's really exciting how much competition there is, not only participating in these markets as a curator, but also as a user. And I'm doing stuff like borrowing on Aave because rates are lower there, and carry trade over to Euler or Morpho and things like that. So I think there are going to be winners. I think Aave is doing really, really well. And I'm happy for all the success. So I think at that size, they're able to support certain trades at a larger capacity that you couldn't do in other protocols. So they're going to have some basically advantages there just because of the size they've accumulated. So there could be some almost sort of network effects there in that they built out, a network of borrowers and lenders that is more robust than other protocols. And hey, they've had quite a bit of a head start over most of them. However, you see innovation like Morpho and Euler that are exploring different models, and models that I think in many ways allowed them to create better capital efficiency and better outcomes, especially for lenders in the short term. And so, I think that the competitive landscape is good. Lending is has some of the strongest product market fit within DeFi. And so, you're going to see lots of competition in the space for quite some time. But yeah, I think Aave always has this thing. They're like, just use Aave. And I'm like, okay, great. But you should look at your other options because you're leaving a ton of money on the table if you don't look. And I think that's a little bit why they like that strategy, is because it's like, just use Aave. It's like a Jedi mind trick, because they're like, whatever you do, don't think about your other options, because then you'd have a complex decision to make.
Yeah. Also, it is extremely catchy. As a slogan, it sticks very well.
So the thing for me, though, is when I see that, just from being online a lot, it looks like African-American vernacular English to me. And I'm like, I'll be honest, I don't think I should use Aave. I think people are not going to like it. They're going to be like, you're kind of a poser.
Yeah. I will say, I do find it funny
You're not
sometimes.
from the hood.
Yeah, when I Google Aave and African American vernacular English is the first result.
Yeah, that's hey. Well, but the great thing with crypto, it's a worldwide user base, and so that's just not a problem for most of Aava's users. And for their brand strategy and stuff, they shouldn't think about that too much. But as someone who was like really on Twitter in 2015, like, yeah, that's the first thing that comes to mind.
Great. As we're kind of coming up maybe on the close here, I'm curious of what is one thing for each of you that you're most excited about in DeFi crypto markets today that you're not working on majorly involved with in any way?
Yeah, I'll jump in and just kind of talk about what I'm playing with in my free time. Yeah, I'm really interested in the abstract ecosystem. Spent a lot of time kind of farming that airdrop. So there's definitely an airdrop coming. So, might as well make a wallet and go do some stuff. But they're sort of working on a gaming chain. And like, as someone who grew up playing, RuneScape and Modern Warfare 2 and Halo and all that kind of stuff, like, I don't know, I see like there's a huge opportunity for this kind of stuff to figure out how to come on chain. It's a huge economy, right? Like, I know even still, I'm not like up to date on what people are spending money on these days, but as people spend thousands on Fortnite and stuff like that. And of course, I spent a lot of money on games growing up too. So I think there's a huge economy in that. I think it's always made sense to be on chain. Quite frankly, I think if someone just built a RuneScape 2 or 2007, whatever you want to call it these days, and just put it on chain, it'd be like a really interesting product that people would use because they have such a loyal following. And there's multiple people at Gauntlet that still talk about this game, right? So I'm really curious to see how the gaming use case plays out. I don't think Abstract quite has it figured out, but I will say they've done a better job of like, I guess, abstracting the user experience from like the blockchain side of things and like trying to focus on actually like usable games. So yeah, I've been kind of playing around with that a lot for the last couple of weeks. Obviously, like trying to farm the airdrop, but also just kind of like actually having fun with some of the games on there. Half of them are just gambling games, so like they're addictive because you're just gambling. But at the same time, yeah, I think they've done a really good job of making the user experience something you actually want to use, regardless of whether you know it's crypto or don't know it's crypto. So I think there's a really big opportunity to figure more of that out, where you can make a user experience where you're kind of people say like combining Web 2 and Web 3, but I think it really is just like abstracting like all of the on-chain side of it, signing transactions, starting a wallet, like getting your private keys, all that, and just giving people what they need, and crypto can be underlying. I think people in really good positions to do this are honestly like card providers, payment providers, like MasterCard, Visa, those types. And I think they should be thinking about it if they're not. And also, just getting yield. Like obviously I'm working on a yield vault, but like it seems obvious that almost every single payment provider or like a Venmo, a PayPal, or any of those that have USD sitting in their vault should eventually just be getting yield. So again, going back to that, like abstracting crypto from the users, like those sorts of things seems like obvious use cases to me that I like. I just love seeing people getting into it, and I'm constantly watching and playing with new products coming out.
I always love the gaming answer. I also like crypto games a lot. I loved Primordium before they shut it down. I don't know if you guys played that one.
Man, there was a game that Horizon Labs made. Forget, like, it was kind of like Dominion, if you guys know that one. Man, I gotta. What is the name of that game? That one was actually pretty popular. I don't know, like 3 years ago, but I don't know. And it was Philippe who wrote the ERC 1155 standard. That was the game that he wrote it for. It's a bit of like kind of Ethereum lore. But oh my god, Dreamweaver, what's it called? Man, I should cut this. I'm never gonna remember the name of it. But it was a Dominion ripoff, and it was actually pretty fun.
Cool.
Just cut it. Yeah, the game's hey, as far as crypto trends that I'm curious about at this point, like I'm not a huge gamer, but I am excited for all of the like tokenized stocks and all the new tokenized products that are coming on chain. Yeah, I want to, and then also, I love the idea of like, I guess what you could call like sort of like a parlay. Like I want to have like, I don't know, like Donald Trump to win the popular, Kamala to win the electoral, S&P to hit, all-time high by end of year. I would like the investment strategies I want to pursue based on my own predictions about the world. They would require some complex hedging that I think that like getting everything on chain would allow me to do. Right. So, maybe you want to go long Tesla, short S&P, betting on the election, betting on a basketball game all at the same time. Like for me, I think having all of these products in one place, it allows me to actually pursue like investment theses personal to me. Where even if you want to do something like, it's kind of hard. Like, let's say you're like, I really believe in Riot Games or something like that, right? Let's see, Riot Games, oh, they're going to come back. Oh, analysts have been crushing them. They're complaining about stock-based compensation. But I really like, what's their game, League of Legends? Anyway, so if you wanted to bet on them, but you didn't want to also just bet on the gaming industry as a whole, what you'd want to do is what every delta-neutral hedge fund does, is you buy Riot Games and you short a basket of assets that are correlated, right? And this allows you to say, hey, I think Riot is going to do well. Not just that video games are going to do well, because you have this huge confounding variable, which is like overall video game interest, which is going to determine the majority of your return, right? So I think having all of these things on crypto will then allow us to use automation, very much like the stuff we're using right now in Aera and in these vaults, to do like custom strategies. And so I would love to just like type into, ChatGPT, hey, can you format a JSON configuration for a new vault strategy that allows me to long Riot Games and short a basket of assets that's correlated with Riot Games, so that I actually have exposure to Riot's management ability and Riot's products, as opposed to just the overall video game markets. That kind of stuff is what excites me. I think, to make another generalization here, like, while I'm excited for crypto to be used in a wide variety of use cases, I think it's very useful in finance now. And there's not a lot of 10x experiences that I've seen in other domains.
I agree with that, definitely. Well, I have to ask now too. I mean, so where do you guys see some of these tokenized stock products fitting into what you're doing? Like, are these things you're currently evaluating how to lend against, or what do you think about where these things are today?
I mean, if all of finance wasn't slowly moving on chain, I think we'd have to consider what infrastructure we need to support these sorts of strategies, or basically vault strategies and automated investment strategies, for other assets. But I think we're betting on crypto, we're betting on blockchain. We're seeing a crazy proliferation of assets on chain right now. And so, yeah, that's always been part of the vision, right? Like, I think, hey, I would love to get regulatory clarity on all these tokenized stocks. It sounds like SEC had some announcements yesterday that it really sounds like they're working on it. But I think given that, then yeah, huge part of the strategy. I think we want to help people use automation and modern financial infrastructure to pursue investment strategies, that makes sense for them. And yeah, so I want to go way out, or I want to push really hard on customization, and really want to make customization better for these strategies as well, and also just expanding the set of assets as well. So yeah, tokenized stocks I think are a great product there.
Nice. All right. Well, as we're at the end, please tell us what people should be looking out for coming from Gauntlet, what websites they should be going to, what products they should be using. Give us all the links.
I'll give a quick spiel here, which is websites, only two that matter, Gauntlet.xyz and Vaults.fyi. But no, I'd say like the Alpha Vault, like honestly, the thing that I love about it is that it really changes yield farming. It really inverts the model. It used to be you frantically have to reallocate your assets to new opportunities, or your yield goes down over time. You put your money in Gauntlet Alpha, we are frantically onboarding new investment strategies to the vault so that your yields go up over time. When we launched a few weeks ago, yields were at 7%. They're already at 11.5%. As Holt mentioned, we do think that those numbers will continue to go up over the next few months. Of course, interest rate environment changing. There's going to be variability, volatility here. And, as we grow, of course, we'll crowd ourselves out of many of these trades, but we have a system now where, we can onboard new strategies, new protocols really, really quickly. And so, hey, you should put your money in Gauntlet Alpha and just see all the new strategies that you will invest in via this automation.
Awesome. Holt, any plugs?
Yeah, I mean, you gotta check out, of course, the Gauntlet Vault, which you can find on the Gauntlet website, which is gauntlet.xyz. And yeah, we're also available on Telegram. You can find me, Holt B1. We do some white glove onboarding. So if you do have like a large amount of capital you want to bring into the vault and you have questions or concerns about anything, you can reach out to us directly. We're happy to help you out with getting in and handling any of your questions. So
awesome.
Rip the Holt's DMs there, because I got like 5 spam messages today on Telegram. So hey, stay frosty out there, brother. There's a lot of phishing attempts. But hey, it's okay to get fished a few times if we can onboard a few new people, right?
Yeah. All right, guys. Thank you very much for all the time today. I'm walking away from this even more bullish on Gauntlet and all the stuff you guys are doing. Thanks for the time.
Nice.
And thanks everybody for listening.